Welcome back, investors. Today we are looking at how we can use technical analysis alongside of fundamental analysis, primarily for use as value investors. I'm a longtime value investor, and so I prefer to stick to qualitative and quantitative analysis of companies to determine the best intrinsic value for that company and to buy them within a margin of safety. However, a lot of people often see technical analysis as the enemy of fundamental analysis, but I do believe there are some benefits and uses for technical analysis, even for value investors. Now, I do want to clarify that this channel primarily for me has served as an opportunity to evaluate specific companies and to dig into that quantitative and qualitative analysis, but I also want to use this channel hopefully to be able to educate others, to help them along in their investing journey as well, and as an opportunity for me to strengthen my own understanding of these different concepts. So we are going to dive in. Looking here, I went ahead and took a screenshot off of Yahoo Finance. This is the chart for Lumen Technologies. As you can see, they've had a significant decrease in price, moving into penny stock territory. And I plan to do a video on Lumen, hopefully in the next couple of days. So keep an eye out for that. If I mess anything up in this video, if I explain it poorly, or if you just disagree or have questions, drop those in the comments for me, because I want to make sure that I am explaining this correctly. And if I need to make some corrections in the future, I can do that. Now, as we can see, I have this, instead of a line chart, I have it set up with candlesticks. There's a whole lot of things you can look at with those. Those were developed actually a long time ago in Japanese rice markets as ways of tracking the buying and selling of rice. So, definitely looking at the history of that's really interesting. I don't do a lot with that, but you can kind of see some of these momentum events that occur. And there at the top, you see an orange line. That's your 200-day moving average. We can see that decreasing. Underneath that purple line is the 50-day moving average. You typically want to see that 50-day moving average increasing, hopefully going beyond the 200-day moving average. That's a bullish signal for traders. Now, that next line is the relative strength index. That tells you how overbought or oversold a given stock is according to the current supply of shares. And then that line below it with the histogram of bars is the moving average convergence and divergence. And that has to do with taking specific periods of data and comparing them along a 12 and 26 pace history. So that one as well, you want to see that purple line increasing beyond that orange line, which is the signal line. And I'll talk through each of these things as we go along here. And so as you've looked at that chart, let's look here at Amazon, and we can see some differences. We see the 50-day moving average has just gone underneath the 200-day moving average, but it's starting to curve up, indicating that there may be a rebound. Relative strength index is going into the 70s, which is very high. We'll talk about that. And then moving average convergence and divergence, we see that purple line starting to move well above the signal line, which is a good indicator. As it crosses over that black line in the middle is the zero line. And so you want to see higher divergence from that to see momentum in one direction or the other. So let's talk about each of these factors and how they can be used alongside of fundamental analysis and for use in value investing. So the first thing is relative strength index. This is, I feel like, one of the more valuable technical indicators you can look at. So I pulled off a little description of it from Investopedia. That's a super great resource if you're just investigating different concepts or trying to understand definitions of things and how they actually work. So relative strength index, RSI, is a technical indicator. It's used in momentum trading, and it measures the speed of a security's recent price changes. Now, why I find this valuable is it gives you an indication of how overbought or oversold a given company is. It's giving an indication of what the supply and demand looks like. And so for me, the main thing I want to see is that a company, especially if I think it's a really good value, is that it's being oversold, that the market is overreacting maybe to some bad news, or it's just overreacting in general to macroeconomic events. So if I see that it's oversold, I know that maybe it could be a good time to buy. It doesn't mean that it is a good time to buy. And that's part of what we need to understand with technical analysis, is that first you need to do strong deep dives into fundamental analysis. You need to understand the company, understand its competitive advantages, and understand what the intrinsic value of the company is based off of its actual revenues and margins and balance sheet and cash flow information. After you've done that, you can start looking at some of these maybe technical indicators just as opportunities to figure out how to use the behavior of traders almost against them. Now, of course, investing is not a competition against anybody but yourself. It's a competition between you and your own fight or flight instincts most of the time. Now, the next thing I wanted to talk about is moving averages and moving average convergence and divergence, MACD. Now you can see on that left one, it notes S&P nears death cross, and a death cross is when the 50-day moving average crosses underneath the 200-day moving average. It's typically an indicator that the price is going to drop significantly, possibly with strong momentum. And, of course, that doesn't always mean that's going to happen, right? It says it nears the death cross. So sometimes people will panic when they see that. They'll start selling it. Of course, that pushes the price down further. So it kind of becomes self-fulfilling in a way. We'll talk about that more. Now, on the moving average convergence and divergence, this as well kind of gives an indication of how others might be interpreting price changes. You might see things that look like it's the start of a bull run. You might see these crossovers similar to the other moving averages, or that there are strong downward momentums that forcing the price down. Again, it's important to understand what's actually happening in the company and what outside of the company's control is happening that might be affecting the price of the shares. And so the more you can understand these moving averages, it helps you understand the momentum that's affecting the price, not necessarily the intrinsic aspects that are affecting the business. Now, of course, we move into resistance and support. This is something I'm going to come back to in a minute. But resistance and support gives you an idea of the high prices that typically traders will start taking a profit at, which will then push the price back down. So a lot of people won't start buying at the resistance level because they assume it's not going to go higher. Now, that's not always the case, right? Historical performance doesn't dictate what's going to happen in the future. Though trading, technical analysis often makes that assumption, right? It assumes that what's happened historically is going to continue to happen in the future. So these resistance and support levels seem like, you can look at the trends, but it doesn't mean that's always what's going to happen moving forward. And so, of course, support levels are points at which maybe stop losses for a wide group of traders have been placed. And that, of course, is going to push the price lower. We are going to talk about that in a second. So again, I'm talking about the pros here, and then here in a minute, I'm going to talk about the cons. We're getting pretty close to that. So moving into this, part of what I want you to take away from this is using technical analysis in your value investing strategy is effectively, for me, the way I see it, is a Fabian strategy. Now, Fabius was a Roman emperor. He was a general in the army, and his strategy was basically don't engage, right? Wait for the enemy to slip up, make a mistake, and then you capitalize on it, right? And of course, like I said, trading investing, it's not a competition against others. You don't have an external enemy, but it's understanding when supply and demand forces or macroeconomic conditions might create an opportunity for you to capitalize on it. So you don't have to actively be sitting there watching all the charts, but it's understanding certain technical events that might provide an opening for you to be successful in your investing strategy. And then beta, this I just wanted to note here, beta is often looked at as a fundamental of a company. So we get a number, we peg it to the company, and tells you how volatile the price is in relation to the overall market. It's a way for portfolio analysts to decide if your portfolio is under diversified, it's too volatile. Now, beta, again, in my view, is not a fundamental aspect of a company. It's a technical aspect. It can be useful. It can tell you if it's higher than 1, it may be more volatile than the overall market. But it also means that when there's good news for the market or a company, it's going to move a lot faster in the upward direction than the overall market. It also means it's going to move much faster down when bad news strikes. Now, if the beta is under 1, a lot of people see that as a really good thing. However, that means that it often, as the market moves up, especially if it moves up quickly, there is a higher tendency for that company to lag in relation to the market. However, it also provides safety on the downside, that it's not going to push too far down even if the market moves below it. Hopefully I didn't explain that poorly, but the main thing I wanted to get across is, in my opinion, beta is a technical indicator, not necessarily a fundamental indicator. It's important to me to not get that confused. Now, I want to dive into some of the problems with technical analysis and the factors in using them that create pitfalls for value investors. So if you're looking at incorporating some technical analysis into your investment strategy, we have to consider some of these things. But these are some of those missteps. You're taking this Fabian strategy, missteps in the overall market that provide you opportunities. So one thing that I noted with technical analysis is that it creates a self-fulfilling prophecy. So when you understand the indicators that traders use for deciding when to buy and when to sell, you can understand maybe bad times to buy or to sell. So like this picture points out, this is the buy point, and then that's where you have your stop loss at. Well, of course, if you're buying up higher than that overall line and you're selling it when it gets to that line, yes, you've stopped yourself from losing more money than you wanted to, but you've also guaranteed that you're going to lose more money than you put into it. Now, of course, one of the things to note is, people will buy into trading and buy into technical analysis because the behavior of the market seems to follow these patterns. Well, they buy into those patterns and they act along those patterns. And if enough people are doing that, they all, decide what the support level is of a stock, that bottom indicator of where the price tends to stop at. They want to prevent losses, and tons of traders all put in their stop losses around that same level. Well, when it gets down to that level, that triggers their stop losses, and that triggers more stop losses, and it triggers more stop losses, and that's what pushes the price down. Of course, technical traders will look at that as, see, I was right. I put in the stop loss at the right time. But all it's ensured is that they lost money, and not that they've held on long term for it to correct itself if that retraction was in fact illegitimate. The next thing is the efficient market hypothesis. Now, I'll probably get a lot of flack for this. The efficient market hypothesis basically assumes that the financial markets and analysts have all perfectly priced in every factor of a company into the share price. that market prices, they reflect all of that relevant information, that there's not any more information you could understand as an average investor that's not already part of the price. The price is perfect, essentially. You can't predict the price, you can't outperform the market, it's efficient. Now, the problem here is that the market isn't always efficient. There's a lot of times when this logically works out, and it's a good way if you're just a long-term investor. Of course, I think in a lot of ways the market is efficient, and you can build a diversified portfolio to ensure that you're not just sitting there speculating, right? That's what we want to avoid here, is that we stop investing and we start speculating. Well, that's a problem. And so we have to understand that in a lot of ways, the market is efficient, but oftentimes, especially with smaller companies that analysts aren't necessarily always looking at, there are opportunities still for value. I definitely believe that. And, again, maybe I get flack for that. Maybe I seem foolish, but this is one of the pitfalls, I think, to technical analysis, is that it doesn't take the time to do fundamental analysis because it assumes you can't find anything or understand the business. Now, the other issue, of course, I've mentioned this, is the assumption technical analysis hinges on this, is that history repeats itself. And I often say this: history doesn't necessarily repeat itself, but it does often rhyme. So yes, there's a lot of patterns that do typically happen, especially in price, in trading. However, a lot of that is self-fulfilling prophecy, and it also looks similar, but it's not always reaction to the same things. And so history seems like it repeats itself, but I don't know that that's the case always, right? Past performance doesn't indicate future performance. And so that's something we have to keep separated as value investors. And I just wanted to remind us of the definition of value investing. I found this helpful picture from Wall Street Mojo. You're the investor. You buy and hold based on your fundamental analysis. Maybe you find a good entry point when other people are really pessimistic, and you find undervalued securities, real estate, or other financial assets. You hold it for the long term, and eventually you are able to realize a future gain in value, and that's what generates profits. Ultimately, that's the goal, right? And I love that Warren Buffett quote, be greedy when other people are fearful, and be fearful when other people are greedy. And I think that sums up how I would use technical analysis. I would use it as an opportunity to take advantage of other people's fear when it pushes the price down unrealistically, but also know when I need to stop buying, because that's when other people are getting greedy. They're pushing the price, they're overbuying it, and that's going to indicate maybe there's a good chance that, the smallest bit of bad news, they'll oversell it. Here's my main takeaways here. I want to get this wrapped up. Number one, technical analysis can create entrances, but I don't believe it's good for creating exits. The exits based on technical analysis often result in you losing money. You need to look, you can look at the short term for maybe a good entrance point. You've decided it's a good buy. You want to make sure you get it at a good price. You want to understand when other people are being overreactive and it's pushing the price down, but you don't want to use it for exits. Maybe it seems over bullish. Maybe you realize it's well overvalued. That would be the time to sell. I'm going to talk about that here in point 6 or 7. Number 2, price is dictated not by perfect information. Again, the efficient market hypothesis. Price is not dictated solely by that. It's primarily dictated by behaviors and emotions, i.e. fear and greed. It's dictated by supply and demand, and eventually it is dictated by fundamentals and value realization. So a lot of times if you're a value investor, sometimes you have to wait 3, 5, 10 years for the market to realize the underlying value, but price doesn't always factor in everything perfectly. And that's something we need to realize as value investors. Number 3, So this is the steps as a value investor that you would take to incorporate technical analysis. 1, you need to examine the fundamentals of the business, understand it, understand the ins and outs, all of the qualities of it, what makes it have competitive advantage, but also the numbers. You need to dig into those, especially over the long term. You need to 2, determine the intrinsic value of that company. Understand what that company is actually worth. Then you need to determine a margin of safety. What price could you buy that company for that you would be buying it for less than the intrinsic value and would provide you enough return if the price reflected the intrinsic value. So if you need a 20% return and you recognize it's 20% undervalued, that might be a good margin of safety for you. But this is going to be solely dictated by you as the investor and your long-term strategy. Finally, after you've done all of that, you should use technicals only for entrance points when fear is clouding the market's judgment and when the market is ignoring the underlying value. There are things called value traps, right? Companies that look undervalued, but maybe they're in a dying industry. Maybe they're losing their competitive advantages. That's why it's important not just to look at the numbers, but to look at the qualities and then to understand whether there really are opportunities for entrance points or if it's just going to keep going down to zero. And then the last thing is sell, but only when the fundamentals cease to reflect the underlying value, or when a better business can be bought for a better price, or when you've achieved a sufficient return and that sufficient return accounts for the taxes as well as selling. Ideally, you've held this business for several years. You're getting taxed at the lower rate instead of the pre-12-month rate that you would get taxed at, and you exit at the time you choose, not when the market's behavior forces you to. Hopefully this video has been helpful for you. Like I said, comment below if you have questions, if I got something wrong. If you've made it this far, I really appreciate your dedication to this information. As always, like, comment, subscribe. I look forward to seeing you next time.